Hey man, let me go ahead and tell y'all this right now. Nothing is 100%, and for a better future, you have to budget your finances and you have to budget your thoughts. Like you have to strategically plan out where you're gonna spend your money. The same way you have to strategically plan out where are you gonna spend your thoughts. Are you gonna spend your thoughts on the future, on positive shit? Or are you gonna spend your thoughts on the negative and the past shit? And whichever one you decide to budget and spend all your thoughts on, that's basically what you're gonna feel, man. So, hey, manage your thoughts, budget your thoughts, budget your finances. Now, a lot of people feel like, man, they don't want to make a budget because they feel like they're gonna have to stick to it or they got to spend less. Nah, if you want to spend all your money, make a budget that pertains around you spending all your money. If you want to invest all your money, make a budget around it. Whatever you make a budget around is basically just manifesting where you're gonna spend your money at and understanding where it's gonna go before it even go there. So it's like, yeah, you can keep wasting your money and budget. Just do that. It's better to have a budget than just wasting it and not knowing where you wasting it at. Because once you create that budget, then you get to see where you wasting it at and see where it's going. But man, today what we got going on, how to buy the dip. We got three different ways on how we gonna buy the dip. I got my notes. I got the slideshow for y'all. The first way, how to identify the buying the dip, is through the relative strength index. So boom, first thing first, relative strength index. Relative strength index is a momentum oscillator that measures speed and change of price movement. It's used to identify overbought and oversold conditions. RSI above 70 indicates overbought level, which is above this level. RSI below 30 indicates oversold level, which is this level. All right, so in order to get the RSI, go to indicators, type in relative strength index, and boom, you see it. It's the first one. Once you pull it up, this is what you want your settings to look like number wise. Number wise, like this 70, 50, 30. It should already say that 14 SMA, 14 to close. So boom. Okay, so like our slideshow says, RSI above 70 indicates overbought, below 30 indicates oversold levels. Okay, so first thing first, what we're gonna do, or what stock we're gonna look at for this is Yelp. Yelp. Okay, if we look at Yelp and we look at the trend of the RSI, no, it's not currently oversold right now or undervalued. A lot of investors call it the undervalued level. So as you can tell, when it get to this 30 RSI, once it got to this support, you always want to look for more than just one confluence as to get into a company. So yup, right now, yes, it was oversold right here, but that's not the only reason you should have bought into them. Yes, it was also at that support level that was once a resistance, that was a support. So once it hit this level, you don't want to buy it at just because it's at this white level. It could still continue to dip. But this is a good opportunity to buy the dip. And also, you never want to enter full sides off of one level. So it's like once you see it come all the way down to the 30 RSI, that's just not, that doesn't mean enter your full position just because it came to that 30 level. You still need to analyze and gain more confluence as to more things and find out if more things are giving you a signal to buy. So Apple is next. Apple RSI, when was it oversold? Last time it was oversold was right here, and look how much it went up in price. It went up 50%. So basically, every $100 you would have invested, you would have profit $50 per $100. So that's a great buy to me. I ain't gonna lie. Next thing first, we got. I meant first. I said next thing is first. Next thing we have is Disney. Last time Disney was oversold, it was at this. It was at this support right here. Boom, boom. And nothing is 100%. As you can tell, this indicator RSI isn't 100%. But it will let you know, like, if I would have bought right here the same time that RSI was below that 30, I would have been up a good 24%. And you want to use this indicator on good companies. Like you want to use this indicator on companies that have good financials, because if you use these indicators on companies that aren't great fundamentally, then it's like some fundamentally negative news or catalyst can come out and it could continue to drop the stock. So it's like even if it's at a 30 RSI, it has to be a good company with potential to go back up, because if it's not a good company with potential to go back up, even if it's at that dip or even at that level, it's not gonna come back up. Next thing we got the 200 EMA. The 200 EMA can help you buy a dip. How can the 200 EMA help you buy a dip? Because it'll help you realize, hey, this is a dynamic support and resistance level. Actually, let me pull up the slideshow for the 200 EMA. The 200 EMA smooths price data over 200 days, giving more weight to recent prices. So this is basically the price, the average price for the past 200 days, with the most recent days has the strongest average. You feel me? Basically, it indicates bearish or bullish trend. If the price is above 200 EMA, the stock is seen as bullish. If it is below, the stock is seen as bearish. Okay, so look, below the 200 EMA, this is bearish. Above it is bullish. Below is bearish. Above is bullish. Let's check it out. Bullish, bearish. It's still bearish as long as it's up under the 200. Bullish if it's above. So, okay, already, as y'all can tell, how I said it act as dynamic support and resistance, you can view this level right here, and you can see every time it come up to that 200, what does it do? It reacts to it. You want to understand how price reacts to a certain level, so you'll be able to profit off of that level. And you see how it reacts at this level every time it comes back down. That's crazy. I marked this up a while ago, and it's right there at it. It's right there at it. I didn't even know that. So yes, every time it gets up here, it pulls back. Now, I'm about to show y'all a good dip opportunity with this next stop, because these are companies that's at it. All right, boom. Every time it comes back here, you can see what it does. Every time it hits the 200, well, not every time. I'm gonna say last time it hit the 200, it ran up 25%, 32%. It's at the 200 right now, so it's like, what do y'all believe it'll do? This is the time to see what's behind this company that could potentially push it to continue to go further, because you just don't want to base it off technicals. The more things you base it off, the better advantage you have of it doing what you would expect it or want it to do. Then we got CAT coming up. CAT is right at that 200 EMA. We can see what happened last time it came to the 200. It ran up 31%. It almost touched there. Ran up 28, it touched right here, went below it. It's not perfect, and it still ran up. So this just shows y'all every time it goes on the dip, you see what happened. And as you can tell as well, you see this resistance level. Resistance, resistance. Broke through, retest, it came back, and it's at the 200 again. So it's like it's a support level as well as a 200 EMA level. So that gives you extra confluence that it could rip through that level, or it could bounce. All right, next is we got the fib retracement. The fib retracement is a tool that I use the least, but it does work. So for the fib retracement, what you want to do is you want to look at the market structure. I guess you do have to understand or be able to read market structure a little bit. But once you're able to read market structure, you want to go to the last lowest low. This is the last lowest low. Look, it's a higher low right here. And this is also a higher low. This is the last lowest low. And this is the last swing high. So I'm gonna also do another video breaking down each indicator separately. So let me pull up. Fibonacci retracement is a widely used tool in stock investing that help traders and investors identify potential reversal levels. A golden zone in the Fibonacci retracement refers to a supply or demand zone that corresponds to the 61.8% or the 50% level. Golden zone is an area that represents where price is likely to reverse or continue its trend. So let's do this. 50 to the 61.8% area would be this area. So every time price gets to this box area, it reacts. Honestly, we can remove this now. And we just gonna remember this is the 50 and the 62 level. So now we're looking at this level. You can see the trend of what price is doing. Let's see, let's pull, so let's check it out. The first time it came to this level, it ran back up 28%, or the golden zone level. All right, so now it's at this golden zone again. So it's at the golden zone. Oh, it's also at the 200. It just broke through that 200. Will it hold or will it fold? Who knows? All right, the next thing we got is zone, and let's see what this golden zone is about. Let's clean this chart up. So first thing first, we're gonna go to the last lowest low, which is here, and then the last highest high, which is here. Boom. Look what happened the last couple times it fell in the golden zone area. Bounce, bounce, bounce. Now I'll show you y'all this one because the golden zone rule isn't 100% and no indicator is 100%. Could it bounce here? Yes. Could it continue its trend of going down? Yes. Who knows? But it's just this just to showcase to y'all that shit is not 100%. And basically, if you wanted to buy this dip, you would have done more fundamental research on this company to help you understand if you should buy. So this is our last buy the dip. How do I know when to buy the dip? Check it out. The last one, AV. Let's see what it's talking about. The last lowest low and the last swing high. Boom. All right. So what happens when it comes to that golden pocket? It takes off. It came up, retested this little gap. It wanted to fill the gap. It came back down. Oh, that's another thing I was going to mention as well. I got on my notes to talk about some gaps because gaps do get filled over 80% of the time. So it's important to talk about. But yeah, every time it comes down to this golden pocket, boom, it take off. From here to that feels like what, over 10%. That's good in my eyes, over 10% move. But yeah, these are 3 ways to know how to buy the dip from the fib retracement, from the 200 EMA, and with the RSI.